Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Energy Engineering Corporation Limited Annual Report. China Energy Engineering Corporation Limited offers a wide range of services across various sectors. The company provides solutions for energy, power, and infrastructure projects both domestically and internationally. The Survey, Design and Consulting Services segment offers planning, research, consulting, engineering survey, design, supervision, project management, preparation and specification services for thermal power, hydropower, nuclear power, wind power, solar power generation, and power grid projects. This includes consulting services for power industry policies. In addition to consulting services, the company's construction and contracting segment provides project contracting, engineering and construction, and project operation and maintenance services for various sectors including traditional energy, new energy, smart energy, water conservancy, ecological environmental protection, transportation, municipal buildings and structures. The industrial manufacturing segment designs, manufactures and sells construction materials, civil explosives, cement products, auxiliary mechanical equipment, energy-saving and environmental protection equipment, and other equipment related to the power industry. It also provides blasting services. Furthermore, the investment and operations segment engages in investment and operation of traditional and new energy projects, provision of financial services, and investment and development of real estate properties. The other businesses segment offers logistics and trading, leasing and commercial business, software and information, and other services. The company's diverse range of services also includes project investment, asset and supply chain management, expressway investment and operation, and power operation activities. China Energy Engineering Corporation Limited market capitalization of $106 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that China Energy Engineering Corporation Limited holds a significant advantage in their industry. China Energy Engineering Corporation Limited trades at a lower price-to-earnings ratio of 6 times and a lower price-to-book ratio of 0.44 times relative within the industry. This makes the stock appear attractively priced. However, the broader industry is also trading at low valuation levels, suggesting sector-wide pessimism rather than the company-specific undervaluation. Further evaluation is required to identify if the company worthy of investment, or could it be an extended period of low valuation or a value trap. The leverage on the balance sheet appears elevated, with liabilities of 76% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 5.34%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified from various sources within a company's financial reports. On the growth side, high-level services for energy powerhouse construction have contributed significantly to revenue increase. The successful operation of landmark projects such as the Saudi Arabia PV project and Tonga Wind Power project has also played a crucial role. In addition, increased sales volume of special cement, expansion into international cement markets, and overseas cement production and clinker production increases have all contributed to growth. Furthermore, the company's diversification into new energy materials, such as photovoltaic materials and new energy storage materials, has led to revenue growth. On the decline side, several factors have contributed to a decrease in revenue. These include refunds of taxes and surcharges, increased cash paid for goods and services, compensation payments under original insurance contracts, and decreases in services revenue. Additionally, losses provision, write-offs, subsequent recoveries of previously written-off assets, increase in credit risk since initial recognition, expected credit losses, impairment losses or gains have all negatively impacted revenue. It is also worth noting that some specific projects such as Hebei Cheng Expressway Co., Limited, Chuntu Luzhu Gas-Fired Power Co., Limited, Shandong Zhejiaoba Yunwan Expressway Co., Limited, Zhangzhou Liuhui Construction Engineering Co., Limited, and Haikou Jiangdong Xinju Third Property Co., Limited, have experienced significant declines in revenue, ranging from 38% to 72%. The net income of the company experienced a significant decline of 30.44% from 2024 to 2025, indicating a downturn in financial performance. However, there were some segments that showed an increase in net income, such as the traditional energy segment, which saw a notable rise from $120,176,030 in 2023 to $152,121,602 in 2025. On the other hand, profit margins decreased significantly for the company as a whole. Nevertheless, certain segments exhibited an increase in profit margin, including the traditional energy segment, which rose from 36.92% in 2023 to 42.61% in 2025. The reasons behind the increase in net income in some segments can be attributed to several factors. The strong growth momentum in international operations, successful implementation of the One Belt and One Road strategy, advancement of the internationalization strategy, and promotion of Chinese standards, technologies, and equipment all contributed to this positive trend. Additionally, the steady expansion of operational assets in power operation business also played a role. Despite these increases, the overall decline in net income and significant decrease in profit margins for the company as a whole suggest underlying challenges that need to be addressed. The company's financial performance indicates a positive trend in its operating cash flow. According to the provided information, net cash flows from operating activities have consistently increased over the past 2 years. In 2024, the company generated $11,027,252 in operating cash flow, which rose to $11,549,705 in 2025. This significant increase suggests that the company's operations are becoming more efficient and profitable, resulting in a substantial boost to its cash reserves. The data from multiple pages of the report further confirms this trend, with each page showing a positive operating cash flow for both years. The consistency of these results across different sections of the report reinforces the notion that the company is generating strong operating cash flows. This is a positive sign for investors and stakeholders, indicating that the company has sufficient liquidity to meet its financial obligations and invest in growth opportunities. Overall, the data suggests that the company's efforts to improve operational efficiency and reduce costs have paid off, resulting in a significant increase in operating cash flow. This trend bodes well for the company's future prospects and provides confidence in its ability to generate positive cash flows going forward. The company's debt level and interest expenses have undergone significant changes. The total liabilities have increased substantially from RMB 171.942 billion to RMB 731.979 billion, a 170% rise. This increase is also reflected in the US dollar equivalent, which has risen by $72.6 billion from $421.7 billion to $494.3 billion. However, long-term borrowings have shown mixed results, with a decrease of $100 million on one page and an increase of 16.5% on another. In terms of interest expenses, there is a general trend of increase. Interest expenses have been described as having increased significantly, likely due to the rise in debt levels. The interest coverage ratio has decreased by 9.57%, indicating that the company's ability to pay its interest expenses has become more challenging. Finance costs and interest expenses have also seen significant increases, with finance costs rising by 93.6% and interest expenses increasing by 90.7%. However, there is one instance where interest expense decreased by RMB 638,428. Overall, the data suggests that the company's debt level and interest expenses have increased significantly, indicating a potential risk for the company's financial health. The company's financial performance varied across different regions and segments. On the positive side, China demonstrated strong growth in operating activities and financing activities. The industrial manufacturing segment also showed good performance. However, other areas struggled. Overseas operations were difficult to assess due to a lack of specific data. In contrast, survey, design, and consulting segments, as well as construction and contracting segments, performed poorly. These underperforming segments hindered the company's overall growth. Management is emphasizing the company's shift towards new energy initiatives, aiming to become a leader in the new energy storage industry with a new model for cooperation and development. The company plans to establish alliances to drive high-quality development and achieve scientific and technological self-reliance. To excel in strategic implementation, management aims to develop signature projects, strengthen core businesses, deploy diversified businesses along 4 major tracks, and accelerate going-out efforts. This will be achieved through innovation, market operation optimization, and deepening reform. The company also prioritizes risk control, safety systems, and intrinsic safety. Management is committed to building a more resilient safety system and continuously improving the level of intrinsic safety. In terms of strategy, management targets 4 major tracks: new energy, new infrastructure, new equipment, and new material. The goal is to become a world-class energy, power, and water conservancy infrastructure construction group. The company aims to fully build itself into a technology-driven green energy enterprise through comprehensive promotion of strategic transformation. This includes innovation-driven, green and low-carbon, digital intelligence, sharing, and integration transformations. Management also emphasizes the importance of lean management, risk prevention and control, and effective resolution of key risks. The company will focus on key national tasks in water conservancy infrastructure and engineering contracting business while optimizing resource allocation and expanding into new areas. Overall, management is committed to achieving sustainable and balanced development through various strategies and plans. This includes exercising overall monitoring and evaluation of its risk management, internal control, and compliance management systems. The company's financial records clearly indicate that it has a history of paying dividends to its shareholders. This is evident from multiple pages within the report, where it is explicitly stated that the company has paid dividends and has even proposed distributing a final dividend to shareholders. Furthermore, specific details are provided regarding the amount and date of distribution, confirming the company's commitment to rewarding its investors through dividend payments. Concerns about inventory buildup or supply chain disruption are evident in the recent financial reports. The total impairment provisions for inventories have seen a significant increase, indicating that the company is struggling to manage its stock levels effectively. Furthermore, changes in balance and provision for inventory impairment among raw materials and products under development suggest that there may be issues with supply chain management. The situation is exacerbated by the fact that inventory depreciation losses and impairment losses on contract assets have also increased from the previous period. This suggests that not only are the company's current stock levels a problem, but its ability to manage future contracts and supplies is also being impacted. Overall, these indicators point to potential issues with inventory buildup or supply chain disruption that need to be addressed by the company. That concludes the financial summary for China Energy Engineering Corporation Limited. Feel free to comment below, and I will be happy to answer them when possible.